In this video, we're going to talk about what can actually shift the investment function. And if you remember back to whenever we were talking about the consumption function, we said that other determinants can shift the consumption function. Well, we have other determinants that actually can shift the investment function. And before we dive into it, I want to do a quick recap on the difference between a movement and a shift. You see, a movement is when we move along the investment function or along a function. So an investment might be caused, or a movement might be caused by the change in the interest rate. You see, what if interest rate falls from 15% down to, I don't know, let's say 10%. So if they fell, we see that this level of investment moves along the investment function, but it doesn't create a brand new line. Whereas a shift is often caused by these other determinants, and it creates a brand new line, a brand new relationship. And you can always tell when a shift occurs because at 10%, we might have been going about with a investment expenditure of say $225,000 or $250,000. But now all of a sudden something changes and we shift that line outwards, and now still at 10%, our interest rate never changed, but all of a sudden we're actually going about and having about, let's say $275 billion worth of investment expenditures. We're still at 10%, and before we were at about $225 billion, but now all of a sudden at the same level of interest rate, nothing really changed. Something changed, but we're not moving along the lines. The interest rate did not change. Something else changed, and now all of a sudden we're producing, or we're engaging in a lot more of these investment expenditures. So we have what's called an outward shift, and that's what I was just describing. It's where more investments occur at the current interest rate. Just like right here, that would be an outward shift, would be going from the blue to the red line, and at 10%, we were at $225 billion. Now we're at $275 billion. Interest rates are still the same, but all of a sudden we're investing more. Another example would be, say, we're now investing $350 billion rather than just $300 billion at 7%. An inward shift is the exact opposite of that. It's when less investments occur at the current interest rate. It's whenever we move from that red line to, say, that blue line. It's where now we're at 7%, but instead of $300 billion, we're only investing $250 billion. So there's less investments that occur at the same interest rate. So what would cause this investment this investment function to shift? Well, you got to stop and think about, why are businesses and households investing? You see, a business must project the profitability of an investment. A business is only going to engage in an investment if they believe they're going to make money or earn more profitability on this investment than what it's going to cost them. They want to have a profitable investment. They don't want to basically buy something for no reason. Households, they must project the feasibility of a new home. Is it more conducive for them to buy a home than to continue to rent it? So both businesses and households must make these decisions. So anything about our expectations about virtually anything that will affect future income will actually shift this investment function one way or the other. So stop and think about this. You're a business, and in your business is going good, and you think that you are willing to expand. Everything's going good. You've got several contracts going on, and you're looking to expand. You're more likely to engage in more investments. But let's say that you're the same business, and you've been going good for a while, and then all of a sudden you look on the horizon, and all of a sudden on the horizon, it's saying that, well, there's going to be some tax reforms. And that tax reforms are going to hurt your particular business. Well, that expectation about the future is actually going to the negative tax implications might actually reduce your bottom line. So if it's reducing your bottom line, you're not going to be quite as excited to go out and spend more money on more investments if it's looking like you're going to have to pay a bunch in taxes. So even though the interest rates might not change, you might not be buying as much. Or vice versa, you might be looking at it and you have 10 more contracts about to get set up. And even though the interest rates might not change, you might be more optimistic and more willing to spend more money. So if you're optimistic about the future profit, lo and behold, the function will shift outwards. You're willing to spend more money at the current level of interest because of the sheer aspect that you are optimistic about the future. So long story short, if you're optimistic about the future, then you are going to spend more at the current levels of interest, and probably that's going to shift the investment function outward. On the other hand, if you are pessimistic about the future and you're kind of a little bit more concerned about it, then that's going to indicate that you're going to spend less money at the current level of interest, shifting that investment function inward. So what are some specific things that can cause a shift? Well, in agriculture specifically, and in other industries as well, technology can cause a shift. So think about it this way. You've got this improvement in production services provided by equipment and innovations. Now, let's say, for example, that you're a farmer and you see this 48-row plow that's being sold versus something like a 24-row plow. Well, now you can say, well, I can spend less time in the field, get more stuff done, and make a higher profit off of that, say, that 48-row plow. Well, that's going to encourage you to purchase that investment or invest in that piece of equipment, even though the interest rate may not have changed. So improvements in production services provided by equipment and innovations might actually encourage you to engage in more investments, even though the interest rate hasn't changed, causing that shift. So we also talked about a little bit earlier, taxes can cause a shift. You see, businesses and households will evaluate their expenditures based on their expected tax returns. So you often hear about different tax cuts and tax incentives. Well, that's going into this aspect. In agriculture, they have different tax cuts, one of which I believe is called Section 179. Don't quote me on that, but I believe that's what it's called, where you can actually depreciate the full amount of your investment in year one. And basically what that means is you get to have a tax write-off on that piece of equipment in year one, reducing your taxes. And that actually encourages you to go out and invest more in your business. Or if you, on the other side, if you believe your taxes are going to increase and you need to save more for your actual tax bill, well, you're going to not be spending as much on investments. So decreasing that effective tax rate, reducing those tax cuts, increasing your taxable rate, decreasing those effective tax cuts, meaning you're increasing the tax cuts, you're decreasing the effective tax rate, meaning the rate at which you're taxed is going down. As that amount decreases, that means you get to keep more money in your pocket. As you keep more money in your pocket, that will actually encourage you to spend more on new capital goods. On the other hand, if your effective tax rate is actually increasing, the tax cuts are going away, and you're getting charged a higher tax rate, then you're not going to have as much money to spend on capital goods, decreasing these expenditures of new capital goods.